Welcome to the Sage Planning Solutions Podcast. Join us as we help you navigate life's financial obstacles and find financial freedom. We will cover the major pitfalls that can derail your journey to financial independence. Get ready to learn, grow, and prepare for your best possible financial future.
Securities and advisory services offered through Catteray Grant & Company Incorporated, a registered investment advisor and member FINRA SIPC. Catteray Grant and Sage Planning Solutions are separate and unaffiliated entities. The information provided here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. Any opinions or forecasts contained herein reflect the subjective judgments and assumptions of the authors only and do not necessarily reflect the views of Catteray Grant & Company Incorporated. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. This information is not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Neither Catteray Grant & Company Incorporated nor its registered representatives or employees provide tax or legal services. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice.
Welcome to the Sage Planning Solutions Podcast. I'm your host, Dominic Ruiz, and I'm joined by my two co-hosts, Matthew Medlock and Brian Marquez. Today is April 7th, 2025, and we are recording this at 9 p.m. Pacific Standard Time. We are recording this because we want to get this out to the general public along with our clients, and we found that this is an effective way to do it since we already have a podcast versus sending you a letter via electronic communication. The reason why is because there's a lack of emotion and a lack of way to connect with people in general when you're sending electronic communication to try to articulate what we're going to say today. With that lack of communication and that lack of emotion, there's a lot of things that can go misunderstood. And quite frankly, we tell our clients that we always have an open line. We do not like electronic communication. We much rather have a conversation, a dialogue with you, whether via Zoom, in person, or over the telephone. This way we have a full understanding of each other. And right now, that's what people need. And that's why we are doing this at this time. This way we can get this out to, like I said, the general public and our clients. But the state of the market, just to read off some headlines, CNBC saying the Dow drops 1,400 points, 10 minutes later, 900 points, 30 minutes later, 2,000 points. When you have a bunch of devices that are programmed to alert you whenever there's important news that is coming out, and then you have your friends, your family members, colleagues, everybody around you in the news and the radio amplifying the current state of the market and economy and everything that's happening globally, it only makes things worse. It causes people to become hysterical, anxious, nervous. This is why people decide to work with financial advisors. We're there to guide you, and it is during this time where we do our best to help clients see that. When we're caught in the middle of a storm like we are right now, this is the time where the relationships become stronger. And everything I've ever learned through my career has been through times like this. Matthew, out of the three of us, you have more experience in terms of the type of crisis that markets have faced. Can you share a little bit about what you've been through?
Well, sure. After seeing what I've seen, and we've talked about this before in my 30 years of this business. Well, 1997, I was an intern and I saw this, and 1999, when I became an advisor and got registered, I saw this. In 2004 and 5, I saw this. In 08 and 09, I saw this. In 15 and 16, I saw this. In 20 and 21, I saw this. You know, we're seeing the same thing here, and it's either some bad guy somewhere across the world launching missiles, it's either some bad guy here doing something silly, or it's all of us collectively doing something bad and giving into that hysteria that you mentioned, or giving into, probably their emotions when they need to be giving into or giving over to their plan, which they once gave over to. It's kind of funny when the going gets tough, we see what happens and how people gravitate, what they gravitate towards. I've seen these sort of periods or eras defined by not only all the hysteria, but more importantly, clients or the general public's reaction to these things. And oftentimes they're reacting to things and building things up. Oh my God, a recession. Wait, what's that mean? Or, oh my God, a tariff? Wait, I've read Oliver Twist or something like that. Does that mean that that's bad? Look, oftentimes people don't have a good indication or a good sort of self-barometer on what's true and what's not and how to react. Yeah, that's why they have us. We're the arbiters of common sense and reason. as well as not letting our emotions get the best of us. It's hard for anyone, even us, to see our own investments go like, hey, what the heck? 2 weeks ago, 2 days ago, they were worth a heck of a lot more than that. What's different? Well, nothing, and so it's upsetting to see. But again, these are one of those kinds of times or periods or things that we're going to look back on, if we do, and say, hey, remember those 2 or 3 crazy whatever, or hey, remember when the Dow, hey, well, yeah, and we'll appreciate the good times again. And we'll grind out the so-so or troughs or, bleak times. But the whole thing is that what people have to realize is that markets and efficient markets, and we believe that. I know, Dom, you and I have discussed about that. We believe in efficient markets, basically letting things work themselves out, take care of themselves. And, it's okay to maybe give things a push, and it's okay to maybe give things, sort of a slight nudge even. But to push them straight off a cliff, well, that's different. And a lot of people think that they're going off a cliff in one way or another. Now, to be fair, a few people have been thrown off the cliff, and I mean that with all respect, with their livelihoods, their retirements. What if they worked at the Department of Education? What if they worked at this? What if they worked at that? Department of Veterans Affairs. I have a ton of veterans as clients, and I sit on a board of helping veterans, and I got to tell you right now, they're terrified. They're not only terrified about the cuts, they're terrified about coming and going the VA hospital. And there's the gal who they used to see for, however many years, no longer works at the front desk. Oh, and by the way, she escorts you back and she asks you how you're doing, because she's the one who kind of nods to the doctor like, hey, remember this guy, he can't hear because a grenade, went off in his left ear. And God's honest truth, I have clients like that who are like, Matt, I don't know what I'm going to do. And I know that from our talking, Matt, that a lot of this stuff's on the table. It's not to be scary, but it's like, what are we doing something supplemental? And are we just relying on my VA benefits? Well, of course not. He doesn't. And that's all. But I'm not the guy who administers, his rheumatoid arthritis care. The VA is, or at least they are supposed to be. So people have some real problems here. And I think a lot of this is they're taking those problems and kind of blowing it up, and at the same time, those problems aren't being recognized. What do you think, Brian?
I'm finding a lot of my clients are split in way of how they think their investments are related to their political beliefs. So, and I've come across a few clients who want to sell all their Tesla stock, and they're finding their biases because of that. And I have clients who want to buy Tesla stock because they support the government. So it's a lot of those types of things. And at the end of the day, when I'm looking at the investments, I have to really focus on what the plan is, right? So what's your plan? Are we trying to achieve growth? And we have to look at what their risk tolerance is, because there's a whole lot of clients that we have that I've come across that are so aggressive in the beginning when things are going well. And then as soon as something bad like this happens, they're all of a sudden the most conservative investor on the planet.
Isn't that ironic?
It's weird.
Well, it's a fear of missing out. I mean, we've had a podcast and talked about that a million times. The fear of missing out, in my opinion, based on everything I've read, is stronger than a drawdown in an equity market, because they're not participating. And it all goes back to trying to keep up with the Joneses, because people don't want to be left behind. Yeah, a drawdown's a drawdown, but as Matt said earlier, if you didn't sell a year ago, because that's where we are in terms of the market levels, why didn't you sell then? If you didn't sell in 2022 when the NASDAQ 100 had a drawdown of 40% and the S&P had a drawdown 25%, why didn't you sell then? Why didn't you sell during COVID? If you still are invested today, you've had many reasons to sell along the way. And since 1980, the average market drawdown is 14% intra-year. So you're right, Brian. It's all based on their appetite for risk. I think we've all had those conversations with our clients that have a political bias, and we have to stay neutral.
We were talking today about systemic risk and not being able to really control that. I have some clients who, we should have sold here, we should have sold there. I was like, yeah, I wish I also had a crystal ball to determine what the expectations were. But But at the end of the day, we're focused on preserving what we can and reallocating to several asset classes and rotating to those asset classes when it makes sense. But with that said, it's really based on the plan. I know it sounds like I'm repeating myself, but it all goes back to the plan.
Well, no, not necessarily. You're not repeating yourself. No, you're 100% right. Think about it like this. Let's say, for instance, let's say you did sell. Let's say you timed this thing so perfect, you sold in January. And let's say you bought back throughout the year. Maybe you bought back a quarter later, right? Well, guess what? They just created a taxable liability for themselves. And then you bought it back. And so you don't know if that's a long-term capital gain or a short-term capital gain, right? In these types of markets, clients look to us to have a steady hand because it's easy to become hysterical. And there's a quote that I love, and that quote is, "Don't make a permanent decision on a temporary situation." And throughout my career, I've seen that time and again. I have friends that work for Betterment and for Wealthfront that were telling me this morning at the open, and Fidelity, at the open, people were liquidating their portfolios. And they were liquidating their portfolios only to see the market go from negative 4% to positive 2% intra-session, all within an hour. And
Wow.
they spent the entire day, I guarantee, watching the market. And even though we ended up pretty much flat, they're going to end up getting back in when the market reaches another all-time high because they say, oh, it's recovered. But to quote again is, the stock market is the only place where when things go on sale, people run out of the store. But if the local mall that has luxury items goes on sale and says, hey, guess what? We're open till midnight. Everything in the entire mall is 80% off, even 80% off of clearance and sales prices. There will be so much traffic trying to get there, which always baffles me because those are guaranteed to depreciate versus saying, hey, I have XYZ stock, let's say Apple or Google, whatever, and a year ago it was $200 and I held it then, and let's say today it's, I don't know, 180 for, this is all for example. Well, if you loved it at 200, you get love it at 180. If you loved it at 100, you get love it at 70. And oh no, it can go down lower. Let me tell you, if the value of your house went down today or a rental property today went down to 60, 70%, are you going to sell it? Probably not.
Of course
So
not.
they're all long-term assets. It's easy to become anxious, but it is during this time where clients expect to have a conversation with us to guide them through these rocky times. And there's always been a reason to sell in equity markets as far back as I can remember. And right now we're dealing with the tariff situation. And before this, it was 2022 where inflation went up to 9.5%. Then there was COVID. There's Brexit, the housing crisis, September 11th, Y2K, Iraq war, dot-com bubble, on and on and on, depression. There's always a reason to sell. My question is, if you didn't sell during the times since you've been investing, why panic today? What's the difference between today and then?
Trump. That's what some of my clients would say.
Yeah, I've heard that as well. And my recommendation is stay away from the news. I get a lot of people say, did you listen to the news? No, I don't. I pay attention to what the market's doing because the market is going to price in every piece of news, and that's going to give us an idea about what's happening in real time. And like I said earlier, if you time the market and you went to cash, and if you try to time the market like you have a crystal ball, you're going to create a significant amount of turnover, constant turnover, which creates slippage, and then the whipsaw effect. Today is a perfect example of that. As I said, at the open, the person sold only to spend the rest of the day. The market's going up, and they're looking at their account like, what did I just do? I'm going to go feel comfortable in a safe money market or savings account or CD and lose to inflation. And I still got to pay tax on that interest. So they went for something that over time has a chance of growing to something that's losing to taxes and inflation. And you've seen that a lot at the bank.
Yeah. There was times where I've had clients who wanted to sell at this point, and I would of course ask them, are they sure? And they would just want to go to something guaranteed. Okay, well, let's go to something guaranteed. May it be a CD, may it be a fixed annuity, and your locked in rate was maybe 3%, 5%, but they've lost all of their upside based on, some some decisions that they, a temporary situation, like you said, and it was a bad one at that point.
Matt, being at the previous firm you were at, did you deal with a lot of these types of situations as well?
Yes and no. There's a couple things that you guys have been touching on, FOMO and stuff like that. But no, my tolerance for these kind of shenanigans and selectivity and emotions, I'm pretty well known for not tolerating any of that. I'm pretty well known for not having a knee-jerk reaction. I always try to conduct myself like I'm a captain of a vessel. Okay. And each one of my clients are on my ship, and they might have different cabins, but we're on this journey kind of thing here. And at any one time, if they want to talk to the captain, just find out how the journey's going and whether or not we should continue on the journey that we set out when we left port. We're like, hey, we got your understanding, right? You signed? Okay, yeah, right, we're good. Okay, well, sometimes things change, and that's fine. But there's a lot of old sayings that I go by, and one of them is calm seas does not a captain make. And if you're a client on my ship, so to say, at any one time, you can reach out and talk to the captain. Now, I'm going to tell you how things are. I'm not going to tell you that it's, rainbows and four-leaf clovers. I'm not going to tell you that it's, it's red skies at night when it isn't. And at any one time, you can say, well, what is our course and why are we going there? Are we just going there because it's sunny? Are we going there because it's safe waters? Are we going there to wait to get to safe waters? Do we have to go through treacherous waters to get to safe waters? The answer all the time is yes, of course. Like, if you don't understand that there aren't, pirates on the horizon, then I don't know what planet you've been living on. And I'm not talking about literal pirates only if you're off the coast of Africa. I'm talking about IRS. I'm talking about your emotions. I'm talking about these yahoos who take advantage of these FOMO people. When you mention the experience at the bank, I think it's a big one. Oh, hey, Mr. and Mrs. Jones, boy, you're not happy with your stock portfolio. Let's sell out of it and let's put you in a UIT or some conjured up, syndicate preferred where you make 6%, but every other year, and it's only a leap year that you get a bonus, and you have to hop on one leg and prove that you have a certain heritage. It's ridiculous. It's ridiculous. It's silly.
We need, with the things that we're dealing with right now, we can use a little bit of comedy, but you're absolutely right.
It's true. So have we got the solution for you, Mr. and Mrs. Worrywart? Have we got the solution for you, Mr. and Mrs. Preemptive Strike? Have we got the solution for you, Mr. and Mrs. Well, I got an advisor in plan, but Well, wait a second. What's the in? What's the in part? Well, hold on now. That's selectivity. So, fellas,
and that's a big one. That's a huge one.
Yeah. We know, fellas, that every time we suit up, so to say, excuse me, whether we're meeting with clients or we're going to meet with clients, our head is thinking about this client and what we can do for them and how 100%. We can best help them and what makes their situation unique, because that's what makes our relationship unique. Now, if they're sitting back and going, well, gosh, I know Matt's busy and I don't want to bother him. Well, you're sitting up there on the poop deck, getting sun and saying, well, Matt's probably busy and it's calm waters. I don't need to talk with him. I'll wait till there's pirates on the horizon.
That's right.
I'll wait till there's a freaking hurricane coming in. I'll wait till we run aground, and then I'm going to start asking questions.
Yep.
Okay, wait a second.
It happens all the time.
Yeah, of course.
More often than not.
It's human nature. And again, a lot of people have been asking me personally over this past weekend, like, what do you do? Like, what are you doing? Well, what am I doing? I'm not doing anything yet. I'm not having a knee-jerk reaction. That's not what clients want. If that client's calling me and I'm on the bridge of this so-called ship and they're going, Okay, well, I want to talk to Matt. Wait, what? Who, where, what? Huh? There's a level of assuredness and like, yeah, I've seen similar stuff, but to be fair, we are in uncharted waters here where we have someone is purposely not upsetting the apple cart. They're setting the bloody thing on fire. Okay. So we all have sort of our own view, whether it's political, financial, personal, how this is playing out, because it's so far reaching and it's so really complex. Again, we have to make sure that we're looking at this for the right way and the right reason. And anytime someone's going, well, what are you buying? Time with my family. What are you buying? Like, if you're out there buying anything, you're buying knives, my friend, and they're falling. They're not sitting in a drawer. They're falling on you. Okay. So if there's deals to be had, that's great. Like, Dom said, what if things were on sale at the mall? Same thing with Ferraris. Oh, well, Ferraris are on sale by 20%. Where's everybody at? How come no one's buying Ferraris? They're 20% off. Well, if you don't see some of these stocks like Ferraris, then I don't know how to help you. Now, a lot of people have these thematic investing and have these sorts of, things and safe havens and whatnot when times get tough. We just talked about that. Boy, have we got a product for you. Whether it's AI or energy or non-renewable energy, does that still hold true? Well, did it hold true before tariffs? Well, it's going to hold true after tariffs, right? Like, again, we're dealing with one apple cart here. There's still the giant orchard behind us, okay? And there's a lot of people out there right now, Spitznagel, some of these people out there who are hedge fund people saying, hey, this thing's going to drop a lot more, and ooh, spooky, and ooh, look out, and boy, have I got the solution. And let me tell you right now, and you fellas know this, I went to grad school for history. I can tell you right now, people have been doing this since like the 1400s, trying with highly detailed mathematical formulas, and they still can't beat it.
Yeah, that's
AI
interesting
hasn't beat it.
because, as we all know, everybody got the friend or they know somebody that made money during this time. The one thing that we need to set the record straight is we're not market timers. We're not using some subscription to an algorithm that is going to go 100% to cash, create a bunch of tax inefficiencies for you, and then you're going to ask me, why did I pay a bunch of taxes? And if that year ends up being a down year and you're paying taxes, that's even more questionable. We're not focused on a high watermark. Your appetite for risk, your objectives, and your goals are going to be different than everybody that you talk to. It's very rare that I meet somebody that has the same goal as their best friend. That would imply they have the same risk tolerance as their best friend. And be very careful where you get your information. Just because your friend is successful or you know somebody successful in one industry doesn't automatically mean that they're going to have the same success in another industry, and they probably have a different investment acumen than you. I would just be more focused on just your own individual stuff. And for us not to write a letter and to have this type of communication, it just speaks in generality, right? We're not speaking to one individual or one type of client in general. We're just speaking as broad based because we have to approach this as generalists, just like a doctor. It has to be very general, because if we're focused on just one type of investor, then it cancels everybody else out. So our clients are looking to us to have, again, a steady hand in these type of markets, and we're not going to be reactionary. And I think that's what people are looking for, because I'm going to say most of my conversations I've had over the past 10 days, they've been more like, so what are we buying? Things are on sale. What do you think? And a lot of them have been trained over the years to look for opportunities in these type of markets versus panic. And I appreciate those clients. I really do, because they've been with me long enough to see the ups and downs of the equity markets and how they turn into opportunities. Because as I said earlier, there's always a reason not to invest. But if we want to buy a stock, coming into this year, I've met folks that want to buy a stock that's 100 or 200% above the 200 moving day average with a PE ratio of 6, 7, 800. That is just ridiculous. It's hard to even fundamentally say, yeah, that's a good idea. And those stocks have come down from space back down to earth, and they found gravity. So are those bargains? I don't know. The market hasn't determined that yet because there's still a lot of headline risk, systematic risk, which no one on earth can protect you from. And let's get that straight. No, nothing on earth can protect you from systematic risk. So we're not hedge fund managers. And the key word in that is hedge. What are they hedging? Situations like this. They tend to lag the S&P 500, the Dow Jones, the NASDAQ in good times, which a majority of the time markets trend higher. So are they doing extremely well during bull markets? Some, but most don't. And I mean, I'm willing to go on record and say that, but they're hedge funds and they make a lot of money during this type of market. And then it's over. So they make a chunk of money during bad times like this, but they also have the bandwidth to make those quick trades and then they're out. They're not looking at it a long-term investment. They have a thesis, they execute, and whether they're successful or not, they're going to keep trying. And they're resilient, just like us as financial advisors. You as investors have to be resilient. You can't let like I said, a temporary situation cause you to panic, make a reactionary decision, and then you just never, you just sell everything and sit on the sideline and watch.
You fellas ever heard of a guy by the name of Stretch Gardner? He literally was Stretch. I mean, the guy was tall, and he was required reading when I first started as even an intern back at Morgan Stanley Dean Witter. And this guy was a war hero, a World War II war hero. He was incredible, and he was a historian. And being a historian, I when I went to New York, it was like a pilgrimage going and working in world trade. And I remember he came and spoke to our class, and then afterwards he stuck around, and I was like talking with him for like 45 minutes. And he had these beautiful like one-liners and like kind of sort of this old-timey saying and all these sorts of quotes and the guy was just amazing just to listen to. You just kind of just sit there and just listen to, at least for me. And one of the best, pardon me, quotes he had is, in times like this, a lot of people either glom onto their stockbroker, right? Or they glom on to whoever, whatever person is talking, whether it be a village idiot, their next door neighbor, their brother Ted, whoever. He had a quote, and I love it, and actually something from the Bible, from Matthew 7:15. Beware of the false prophets who come to you in sheep's clothing, but inwardly are ravenous wolves.
Amen.
He said, you must be careful. You must do your homework. You must think for yourself. You must go beyond the issues of simply, and he's talking to us as back then advisor trainees. He's not talking about just average investors. He's talking about what we do. Now, you would think that he meant everybody. Well, that's our job, and we take our job super duper serious. So yeah, I mean, and if we're not having these conversations, some yokel is. And that is an issue. Okay. The other thing that he had is, Dom, you asked, do I ever have any clients who ever get antsy or sell out of portfolios? I only had one, and it was actually when I left. And I remember this guy was super emotional, and the Dow was at like 30,000, and he completely regrets obviously doing what he's doing and what he did, and he sold out. And I remember he said, well, I'm just going to sell in May and go away. Exactly. How laughable is that? And I'm like, where did you get that? Like, I've never said that. Like, who? And he goes, well, I said, look,
that's been proven to be statistically incorrect time and again. But it's an old school saying that people like, just right. Like it's the stock market. It's the only place that goes on sale and everybody runs out of the store.
Right. And so I'm like, okay, how do I handle this? Because I've known this guy for 20 something years. He's highly emotional right now. This was, just totally out of character for him. And I was like, okay, well, I went back to what old Stretch said. Okay, and that's the second quote. Okay, and he stole this quote, by the way, shamelessly, of course, from Mark Twain. Mark Twain said, October, this is one of the peculiarly dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and February. Like, dude, in other words, if you're in, you're in. And if you're out, you're out. I can tell you right now, he's looking at this come down saying, oh, I knew it was going to come down, 3.5 years later and 45% higher. I knew it was going to come down. Well, why aren't you buying? Again, there's that selectivity. There's that human nature. There's the fear and the greed. We talk about this. These are what we're facing. So a lot of times clients go, oh man, like I bet the market sucks. I'm like, I don't really have a problem with the markets. I have a problem controlling people's responses to that. And I've done well. I mean, I don't have this issue hardly ever anymore, thankfully. But it's sort of like a delta, right? It's not really the market, it's the reaction to the news. And that's exactly what's been driving the market for probably about the good past maybe 5 or 6 years. It's not the news, it's the reaction to the news, right? So if we look at trading charts, if we look at even what Goldman Sachs says, when you talk about being in the market, not timing the market, Goldman Sachs has spent oodles and oodles of gazillions of dollars on this sort of stuff, and they've crunched the numbers. Now, for what it's worth, I don't trust them completely, but I do trust this statistic and the fact that they said that 89%, more than 89 actually, 89% of all investment returns could be attributed to asset allocation. But there was a part B. It wasn't only asset allocation, it was time in the market, not timing the market. Correct. And all of the investment returns can be broken down. And they said, if we had an actively managed portfolio, you could take your pick. Nothing has beaten this. And it's like, goes back to the old bet that Warren Buffett made that still no one's taken. Hey, if you could beat me, or if you could be SB with your hedge fund or your fund of funds or all that gobbledygook window dressing, iceberg theory, dodgy dark pool stuff that you're doing over there, if all that chopping and changing that you can do 24/7, because that's what you do, if you could beat me, we'll have at it. So far, no one has. So there's that kind of old-timey way of saying, hey, slow and steady wins the race and keeping at it. Well, that's what I'm saying. That's what we've been saying. I know that. It doesn't take good old Stretch Gardner here, right? Like, God love him. May he rest in peace. He lived in 95, a war hero for this country. But also a sage man when he's given this advice, like, that was back in 1999. He passed away in 2018, and he's sitting back then. And I remember this guy's huge. He's so tall. I'm 6'4". I don't know what he was. Way taller than me. And he was just real casual and like he had seen everything. It's like, son, I've seen everything. I've seen tough stuff. This too shall pass. I've been through 97. I've been through, 89. I've been through 87. I've been through, 91. I've been through all these things. You're going to see your things too. You're going to have stories of your own. And that's what they're going to be. They're going to be stories.
Piggyback off that Goldman Sachs study, I read another one from JP Morgan that says 7 of the 10 best days took place during bear markets, which of course, like I said earlier, the whipsaw effect, the person selling at the open of the market only to spend the rest of the day watching the market recover, and they sold at the bottom. Just like in 2020 during COVID, the second best day happened immediately after the second worst day. So for all these market timers out there that said, oh, well, we're sitting in cash and then we missed the worst days. Yeah, you also missed the best days. And then you spend the rest of the year trying to articulate the reason why you were sitting 100% in the cash while the market flew. And then your client's like, well, yeah, you protected me the downside. But again, like I said earlier, FOMO, fear of missing out. Market ended up being 20% after a big crash. Having a steady hand in this type of market, it's chaotic. We understand that. And we just want to let you guys know that we're here to have a conversation. The electronic communication is very ineffective. Talked to a couple of friends over the weekend and said, give your financial advisors a call. Don't email them. Because the minute that they see your email, their blood pressure is going to shoot to the roof. And you're not doing them any service by doing that. It's impersonal. And be kind to them. They're dealing with a lot right now. And it would be nice if they could just have a nice conversation, because not everybody can handle the same level of stress. And this is a stressful situation for not only for us and our clients, but everybody in general. Even if they have no money invested, the economic consequences if things don't go well could be catastrophic for families and small businesses. So, like you said, the Veterans Affairs earlier, have a conversation versus trying to hide behind an email. That's why we're doing this right now at this time. It's almost 10 o'clock. Instead of sending a letter that's pre-made. We all been at firms. I know you have, Matt and Brian, worked at places that had these pre-made emails. Oh, send this to your clients. And we were trained to call your clients when the markets are in chaos. And quite frankly, I'm not comfortable with that. And I'll tell you why. It goes against everything that we're talking about right now. 100%. If I call you, that means I am panicking. What do I say? Oh, Mr. and Mrs. Jones, how are you doing? Are you okay? I learned very on, because I said earlier at the beginning of this podcast, most of the stuff I've learned is through markets like this. I remember 2008. I did that because I was trying to do that. So what happened? Mr. and Mrs. So-and-so, are you okay? And they said, what do you mean? Well, the market's in turmoil. I just want to make sure you're checking in. And the client taught me a lesson. They both were on the phone and said, when you call me like that, it looks like you're panicking. And I was like, well, no, I was asked to call. But I was also very new. But I took that as a lesson. And he was like, look, young man, I like you. I can see you're bright. But piece of advice, when you call your clients during this kind of market and check in, it looks like you're panicking. And I want to continue to work with you because I believe in you. But just know that. And I took that, and I've always had an open line of communication with my clients. There's clients you can call all year and they won't call you back until this kind of market, like you said earlier, Matt. And it's always ironic. You can meet with a client, everything could be okay a month ago, and then this happens, and then they call you panicking. It happens often when these type of markets hit. But the last thing I do is send a cheap email. I'm going to call you back right away. You're never going to hear me say, oh, I'll call you within 24 hours. And if your advisor can't get back to you within that same business day, there's a problem. If your advisor has their assistant call you, that's a problem. If a client calls me, I know you, Matt and Brian, you guys are on it. It's the minute you guys get a chance to call your client back, you're going to call them back. My clients know if they call me or even email me, I call them right away. I want to have a conversation with you. I want you to know that I care. I want to show you that I care. And I try to have my actions and my words be in line with my morals and values. I'm not going to make you wait all day. How many times have you had to, in your career, Matt, send these bogus emails, or that the company automatically sends them on your behalf? And that's not even what you believe.
Oh, that's one of the reasons why I left, misrepresenting me. Because it would send these bogus emails and go, oh, and by the way, have you heard about our new loans? It's like, wait a second. Like, first of all, you're preying on this opportunity and or people's attention to push products at a time where, dude, like, just read the room. And so they don't do that. They would rather fill the silo rather than read the room. Okay. And they're filling the silo and they're preying on this stuff and they want to do it. They want point of sale. They don't see you as a client. They see you as an account, and they're going to pop you into something. And hey, great. We'll, transfer that out if you can ever liquidate it in 6 years when it becomes whatever, when it trades on some market in Uzbekistan or whatever. That's the kind of stuff that we see. But when you go back, and I appreciate you saying that, I don't really have, and in fact, I'm blessed. I don't have anyone who ever thinks that, oh man, that Matt I might have had that like decades ago, to be fair, at that wirehouse, because I might have been misrepresented or might have not said the right things. But I can tell you right now, every single client knows that our best interests are intertwined, that I would never, ever even think about doing something that would hurt, harm them, that is counterintuitive, productive. Why would I would never do that. It very much is akin, if not the exact same thing, to the analogy that I use with everyone. Like, hey, I'm not going to run this ship aground. I'm trying everything I can to do to keep us afloat. Now, I know you might see bandits over there. You might want to fire off on them. You might want to be aggressive. You might want to get back into, and those are NVIDIA bandits. They're wearing the NVIDIA logo. Oh, so you want to get back into that? Well, hey, look, I'm telling you, you don't need to fire off of those bandits. They're just bandits. You own these high seas. Don't be messing around with that. Sometimes there's an old saying, the trick isn't worth the time it buys. And sometimes it is. For a lot of people, when we look at their things, it's like, hey, I think, like if your doctor said, hey, I think getting on this or that's good for you. But if it kills you before it cures you, then it ain't. And at a certain point, people need to adult, and there needs to be a level of accountability on their own side and their own part with their emotions to keep them in check. Also, their expectations. Like, look, I am not Scottish. I do not go by Mr. Scott. I am not a miracle worker on the Enterprise. So when you call me, I'm not going to tell you, well, hey, I'm going to get it all fixed in 2 hours, but it's only going to take me 1. That's not happening here. This stuff's going to take a while to play out. But in the meantime, if you're going to come around and or listen to the Village Idiot or some yahoo on TV who can't say the C word for thought of being either offensive, bleeped, the word crash. He can't say that. They can't say it on CNBC. Like, I get it, and that's fine, but we're going to censor that word. Why? We're not doing it for logic. We're doing it for people's emotions. That's like one of the silliest, weirdest. It's just bizarre.
Well, that's why I was reading those headlines. They might not say that word, but just looking before we started, all these headlines, negative 1,400 points, negative 600 points, negative 900, negative 2,000. Oh my God. They're just creating more chaos for folks.
Bad news makes headlines.
Yeah. They're scare tactics. They need clicks. They need viewers. And we just want to let clients know that we care. We're happy to have a conversation, and we're not going to send you a letter. We're not going to call you that shows that we're panicking. If you want to have a conversation, please reach out. And I just want to read this one quote in closing. It's from Jesse Livermore. He says, quote, after spending many years in Wall Street and after making millions and losing millions of dollars, I want to tell you this. It never was my thinking that made the big money for me. It was always my sitting. Got that? My sitting tight. And I love that quote because we're playing the long game here. We're not looking for short-term tactical moves and creating all this tax inefficiency for you and slippage and turnover and all this stuff. And again, we don't have a crystal ball. We're not going to pretend that we have a crystal ball. We want to make sure that we're helping our clients do everything long-term. And in closing, thank you for listening, and we will be back soon.
Thanks for listening to the Sage Planning Solutions podcast. Be sure to subscribe so you don't miss the next episode. If you want more information, visit our website at sageplanningsolutions.com.